Hello, today is the 14th of December. We are rolling towards year end. Very interesting week, wasn't it, Andy, last week? Bonds absolutely hated it, and the stock market couldn't really gain any traction apart from tech stocks as a result of the backup in the bond yields, especially at the long end. What did we have? We had 14 basis points up on the 2-year note, and we had 25 basis points up on the 10-year note. So a noticeable steepening. And also, for the first time in, just about 2 years, we've had the 3-month against the 10-year note disinvert in yield and basically have a positive yield. All this in a background where the Swiss National Bank cut by 50 basis points, the Bank of Canada also cut by 50 basis points, the ECB cut by 25, and China is also making easing noises of their monetary policy. And yet US bonds just don't like it. So what was the data like? Well, it was warmish, wasn't it? It wasn't totally as expected. It was slightly higher in terms of CPI and PPI, but PCE looks like it will come out exactly where the Fed, or the market rather, presumed before the CPI and PPI numbers that it would come out at. And that is surprising in a way that there was such a big reaction in the bonds. What do you think, Andy? What do you make of it?
Yeah, no doubt. Bonds sold off a lot. I look back at where we are over the last 2 weeks, well, really since the election, but really since prior to Thanksgiving, and say what's changed over that period of time, and really nothing much. Data continues to be warmer than desired on the inflation front and strong everywhere else. And when you add that up, what has happened since Thanksgiving? Well, so right before Thanksgiving, the Treasury Secretary nominee was announced, Scott Bessent. And during the Thanksgiving week, which was illiquid, which also ended the month of November, the bond market started squeezing from levels that are not that different from where we are today. Bonds yields fell, 2-year note yields fell, 10-year note, the whole curve fell, on expectations that Bessent would be a good nominee and achieve his goals. Germany and France had political turmoil that caused, and just the ongoing weakness of non-US economies resulted in a bid for bonds and European fixed income in general, with some turmoil in the French elections, also creating some risk off. You had the end of month buying, which was clearly favoring bonds. And so bonds just squeezed and continued to squeeze, despite no reason for them to have rallied during that period of time. Similarly, there's really no economic reason for them to have fallen this week. But nonetheless, they did. And it was significant selling of basically every financial asset, from gold to nominal bonds to TIPS to non-tech stocks. This week, it was just a simple liquidation. And so here we are. And the data remains the US is doing better than everybody else and is strong. Everyone else is in need of easing, weaker domestic currencies, and stimulus in some cases, in fiscal stimulus in many of the cases. And the US is not. And so we go into next week, this coming week, with the FOMC at a pretty critical juncture, I think. What do you think about this coming week?
Yeah. Well, we also get, before the FOMC, on Tuesday, retail sales, which is the last of the inverted commas Waller plots, last of the data that Waller mentioned that he will be looking at to make up his mind whether they cut or not, although the market is assigning a 96% probability to a cut, so I would have thought it's a lock. Retail sales is going to be hot because the US consumer is just on fire. The only two sectors that managed to eke out performance compared to the rest of the market were consumer discretionary, because the consumer is on fire, and the tech stocks, the tech sector, because it's just on fire. The Mag 7 and all the tech stocks are looking for much stronger growth over the next few years. Having said that, we get, as you said, the FOMC after that last piece of data. And I can't help but think that unless the FOMC is hawkish, either in its dot plots or in the, how shall I put it, in the presser, and the presser needs to be very hawkish, but I've never seen, in years, we haven't really seen the Fed chairman be able to be hawkish, right? He's just as dovish as doves come. So unless that happens, I think that my conclusion, and we'll go through why, is that the 2% inflation target is no longer a target. It's a wish list, as opposed to something that they really wish to achieve over the course of the short or even the medium term. And really that the target is not the target, but they would tolerate inflation 2.5%, 3%, and they're not going to do anything about it. So what are we going to see from the dot plots, do you think, Andy? I think it's very hard that we see anything above 3.5% terminal rate, and even that is going to be difficult for them to get their dot plots up towards.
Yeah, so let's outline that briefly. So there are three basic categories of things that are events that are occurring around the FOMC. There's the rate cut or not. 96% chance they cut rates. Very hard to be hawkish when you're cutting rates. The next piece of information we'll get at the same time is the dot plot. The dot plot has two pieces in that. One that really matter. There are lots of information, but the things that really matter are going to be looked at are the projection for the cuts for next year. They'll have cut 100 basis points. The dot plot that they did in September suggested another 100 basis points of cuts. We'll see if that changes. And then the longer run interest rate, which has been the so-called terminal rate they use, or the neutral rate to judge whether the policy is restrictive or not, and the direction of travel, has been slowly creeping up from the low of 2.5% during COVID to 2.9 today. And so that's going to be the other rate that we're looking at, and that should continue to drift up. And then lastly, the press conference, and that is Powell doing whatever he's doing to validate the action taken today, on the day, and to speak to the dots in a way that says, whatever the dots say, here's the message I'm trying to give. And it's my view, and I think Nick shares, it's going to be very difficult for him to out-hawk the market, meaning to be even more hawkish than the market is pricing. And that can be seen by the fact that the current terminal rate in the market is not 2.9%. It's closer to 3.5%, 3.75%. And so you're going to, if they cut, which again, they're going to do, it's going to be very difficult. The dots are unlikely to rise meaningfully, but they'll rise a little bit. And Powell is terrible at being hawkish. He's only done it once since post-COVID, and that's during the Jackson Hole 2022 speech. He's terrible at being hawkish, and so he's not going to be, most likely. And so the market is going to take whatever happens after a 25 basis point cut as dovish.
Right, unless he is very hawkish again. What I'm worried about is that he has dissenters, and how is he going to be able to both cut and not be hawkish if there are dissenters appearing on the scene inside his own committee?
Right.
It's going to be a juggling act, isn't it? It's going to be quite difficult.
Yeah,
So
I
what?
think that's right. I think the idea that Nick and I definitely share is if they cut, he's gonna be hawkish. Listen, it's possible he could still be dovish, and then we have very significant things to do, but that seems extremely unlikely. He's going to try to be hawkish. The question is he going to be
Will he succeed? Yeah,
right?
because he's so terrible at it.
Right.
So historically, from historical experience. Yeah, no, I'm thinking it like this. If they do cut, and if there are no dissenters, and he's not particularly hawkish in the presser, and the dot plots haven't gone up more than, say, 20, 25 basis points in total, then he is telling me that he's not really that serious about inflation. Because you can't keep on getting a series of higher numbers and not acknowledge their existence, because that's what he basically would be doing, just saying, well, eventually we will have lower inflation, but I'm not going to do anything about it. I'm not going to slow the pace of cuts significantly. I'm still on my merry way. Well, if that is the case, I think nominal bonds, the long end, just won't like it. And one has to say, okay, if that's what you're telling me, then I have to buy A, equities, B, real yields, and C, gold. And that has to be the bulk of my allocation. What do you think, Andy?
100% agree. And I think the point about him being dovish, the inflation targeting and what it means is you wonder whether he could be something else. And then you look at what he has been. And that's been the message. That's been the message. The message of don't worry about it. Inflation's going to magically go back to target without any job loss. We've got this. It's a soft landing for the economy. And mission accomplished has been the message. And if it continues to be the message, you just can't own nominal bonds.
Yeah. Okay, so we know what we're going to do if he is dovish. If by any chance they don't cut, okay, and the odds are 3-4%, what do we do then?
Right. So if he does if he does hike, then
Not hike. If he doesn't cut, if he holds.
If he pauses, that's hawkish. That's saying we see the market expectations and we're going to actively counter market expectations. That is decidedly hawkish. I don't care what happens, that's hawkish. So what does that mean? That means that the Fed is quite serious about the data, has made a correction to interest rates from 5 3/8 to 4 5/8, or that range, 75 basis points of cuts, and that's enough. And now we'll be data dependent. And that's the kind of Fed that can really normalize the economy and achieve its goals. And so, to be honest, that's pretty good. I would like to see that as an American, as an economic participant. But what does it mean for markets?
Well, the nominal bonds should like it because the real rate would become very high, wouldn't it? Because if we're convinced that through action rather than words, they're going to take inflation, they're serious about taking inflation down all the way down to 2%, then this kind of level for 10-year notes is a relatively high real yield. So the nominal bonds, the back end of the curve should definitely like it. And eventually, after a little bit of a washout, equities should like it too, because it's probably the best economic outcome, isn't it? Longer term.
Yeah, to make sure that the economy doesn't overheat while also making sure that they have, by knowing that they have plenty of room to cut if things do start to weaken, that they just start cutting again if things start to weaken. That's what Goldilocks is. Right now, Papa Bear is experiencing too hot. It's not too cold. It's not Goldilocks. It's too hot, and that's not when you want to eat the porridge. And so I'm totally agree that the best outcome after a digestion from stocks probably falling a bit, that's when you want to be in a asset portfolio that's well balanced.
Yeah. So then you buy the dip in equities because that it's good for them in the long term. You maintain your long in the longer duration, or you add to longer duration as well. You might even add to real rates, because it's just good for them. Eventually, it will be. So I think, know what to do in either case. I think one case is 96% and the other case is 4%, unfortunately.
Right. And the question comes down to when you get into the 96% case, there's a range of outcomes. So we discount the idea that he's going to be cutting and dovish. Let's assume that's not much part of the distribution. We should probably deal with it, but not much part of the distribution. There's this other part of the distribution, which is cut and try to be hawkish. And it's hard to believe that he can be, but there is an outcome that would look the same as the scenario we just set, which is somehow Powell massively out hawks expectations while cutting. If he were to do that, I think the playbook is relatively the same as if he didn't cut.
I agree with you. I think it's going to be good for asset prices eventually. It might cause a week of turbulence, but I think stocks will stabilize and start doing better into year end. And I think nominal bonds will like it as well. The long end of the curve will like that as well. I think the only thing that nominal bonds won't like is a cut and a dovish presser, and very little change to the economic dot plots. You want to go into gold, you want to go into real rates.
Yeah, will just repeat, dovish can still look like Powell being hawkish in the press conference, but not hawkish enough. Yeah. And in that case, the bond market will not like it and will have to adjust positioning.
But in any case, we will probably have to change allocations according to the eventual result of the FOMC and the presser. So we will be contacting you at about 3 p.m. to 3:30 p.m. and telling you exactly what we're doing and why.
This is Wednesday.
On Wednesday, absolutely.
Thanks, everyone.